Welcome back to the deep dive. Today, we're taking a close look at the LGNS token. It was marketed pretty heavily as DeFi 3.0, and our mission here is really to understand what went wrong. Why did this thing, well, implode? LGNS hit an all-time high, about $84 back in April 2024. Now, it's trading way down in the low teens. That's an 80+% crash. And that kind of drop isn't just market noise. It feels like a sign of deeper issues.
Absolutely. And what's really interesting, or maybe alarming, is the scale of what they initially promised. LGNS wasn't just a token. It was meant to be the core of this privacy-focused protocol. They talked about staking, anonymous payments, and this complex idea of algorithmic non-stablecoin issuance, basically managing its own value internally. Plus the big hook, auto-compounded ROI. Every 8 hours. It sounded, well, incredibly high yield, very automatic.
Okay, yeah, that does sound ambitious. Let's maybe unpack some of the structural problems then. When you look at the data trackers, lack of basic info is striking. The circulating supply, often just listed as unknown, and the market cap. Several trackers listed as, like, 0 or indeterminate.
Right. And that indeterminate market cap, that's a huge flashing red flag for you, the listener, the potential investor. It basically means these trackers, they can't confidently value the project. It points to really poor liquidity, maybe very opaque data behind the scenes.
Yeah.
Serious projects, they publish clear supply numbers, audit results, governance details. It's standard practice. When key figures like supply are missing or just unknown, well, you can't possibly calculate the real risk of dilution or inaccurate pricing.
That lack of transparency alone is worrying. But then there's the incentive structure. This is where it gets, well, really interesting. You mentioned the auto compounding every 8 hours. They also had bond sales promising no cap earnings. But the big one seems to be these multi-level referral commissions, up to 15 levels deep.
Yeah, 15 levels. And that structure, it really raises serious questions about sustainability, doesn't it? When your whole system is geared towards rewarding recruitment, 15 layers down. The sources we looked at called it pyramid-style incentives, and frankly, weapons-grade nonsense.
Yeah.
It strongly suggests the profit model isn't about the protocol doing anything useful, but just about pulling in new money through recruitment.
Right. Recruitment paying earlier recruiters, that sounds like a classic recipe for eventual collapse.
Yeah.
But 15 levels, that specific structure, it almost seems designed to drain value quickly, right?
Exactly. It creates this constant outflow to pay commissions. As soon as recruitment slows down, even a little, that economic instability just becomes completely exposed.
Yeah.
And adding to that, there were major transparency issues with their tech claims, too. They boasted about, 137 plus smart contracts. But the sources couldn't find any credible independent audits, no real track record of large-scale on-chain usage to prove those contracts actually worked or were secure. Contradictory stuff.
Okay, so let's pull back. What's the takeaway here for you, the listener, trying to navigate this space? The overall verdict seems pretty clear. LGNS was extremely high risk. Maybe just speculative talk dressed as DeFi.
I think that's fair. It really failed some fundamental checks for transparency and legitimacy. The key thing for you to distinguish is this. Look for projects with transparent supply, properly audited code, and, crucially, real demonstrable utility. That's one side. On the other side, you have projects emphasizing easy withdrawals, super high yields, plus a deep referral system. That combination. Historically, it's a very strong signal of high risk. The rewards are likely coming from new recruits, not sustainable activity.
Right. So that leaves us with a final thought for you to consider. How often does that shiny promise of no cap earnings just hide, well, fundamental economic flaws? And maybe more practically, what are your non-negotiables? Those 3 key transparency items, maybe supply metrics, audit reports, and proven on-chain utility that you absolutely must see before even thinking about engaging with a new protocol. Something to think about. We'll catch you on the next deep dive.